If you take that same index and you price it not in dollars, but you price it in gold, so you price the return of the index in ounces as opposed to dollars. If you price the Standard & Poor's 500 in gold as opposed to dollars, in the last 26 and a half years, it's down 65%, not up. That might blow some people's minds.
Hey everyone, welcome back to the Investment Playbook. I have Peter with me today. And Peter, I want to get into gold, the Strait of Hormuz, and the Gulf states for today's episode. Recent discussions and even recent presentations, I think this is very timely. First off, we've already done a podcast on gold. It's a long one, so take 3 drives to work to listen to it. I'll link it below so if you guys have not listened to it.
Right.
There's a lot of history that is very relevant to give more context to this conversation. Quick refresher, gold it's a precious metal. It is an element on the periodic table, meaning that in its most purest form, it can't be destroyed. And it's a central bank reserve asset, meaning surplus savings or even strategic savings can be placed here to maintain purchasing power in the future. And what for, we'll talk about.
And just the importance of that. If it's being saved, if surplus savings are going into gold at central banks all around the world, if they're buying, that is a perpetual bid to buy gold for years and years and years as they're accumulating, and they're currently accumulating.
That's right. Long-term views shaping the dynamics of the market here. So gold, therefore, would also be considered a store of energy. There is a cost to mine gold and refine gold. That is priced in as well, which I think is very important that everyone understands. I've heard this from you multiple times, Peter. Gold is a zero coupon government bond of infinite duration and finite issuance.
Yeah, so I should talk a little bit really quickly on both because these are very important concepts. Most people don't think of gold as a store of energy, but then there's another element to it as well, and that is why do central banks reserve gold as a strategic reserve asset longer term? And one of the big answers to that is energy. Why? Because if they simply reserve their surplus savings in dollars or in treasury bills, let's just say, over time, those dollars, those treasury bills don't necessarily fully and always keep up with inflation, meaning that however many barrels of oil you could have bought in at the time you reserved those surplus savings may not change all that much, 10 years later. You may, if you bought 8 barrels of oil, you could have bought 8 barrels of oil today for that unit of dollars. It may not change into the future, but with gold, when you reserve gold, because it does tend to keep up with monetary debasement, monetary inflation, price inflation, much better than really almost anything else out there. Conceivably, when you reserve gold, you may be able to buy, and probably will be able to buy more energy, not less energy into the future than you could have spent today.
Yeah, I mean, it's pretty simply put, but I mean, if you're a central bank, you're investing your savings in something that is going to buy you more things in the future.
That's right.
You're taking a long-term look at what is the most effective way for us to secure our energy future and or our sovereignty. So gold is a big answer.
Big answer to that. And the second part of what you're saying, it's another definition of gold is actually it's a zero coupon government bond of infinite duration and finite issuance. So what does that mean? Zero coupon meaning that there's no coupon. It does not pay interest, unlike a government bond would pay interest. But it's also like a government bond in the sense that if you measure gold in ounces and not necessarily dollars, is guaranteed. Like you mentioned before, it's an element on the periodic table and therefore cannot be destroyed. So it's infinitely secure. It's also of infinite duration, meaning it doesn't have an expiry date, whereas a bond would have an expiry date. This has no expiry date. It will literally last forever once you put it in storage. And I mean forever. And then finite issuance, while government bonds can be issued infinitely, meaning that there's no real limit. Well, there are probably some limits, but generally you can just issue more and more debt. You can't easily issue more and more gold because you have to go mine it, and mining is very expensive. So yeah, but it is in a sense a replacement for government bonds. It's different. It's not exactly the same, but there are reasons why you would want that over gold if you're a central bank.
Quickly, once again, why do we use gold as a tool in managing money? Why do we hold it for our clients? We know just from data that including gold in portfolios, you can actually decrease volatility, which is we measure by standard deviation, which is very important for managing money.
Yep.
And as a byproduct, we're looking at increasing Sharpe ratios, which is quality of return for unit of risk. And if we're decreasing standard deviation and still improving total returns, well, voila, there you go. And really, The kind of spoken about things is really against guarding both the left tail and the right tail risk that exists in the market of the unforeseen that you really need insurance for, right? I mean, people buy insurance for all sorts of things. Gold is insurance for those kinds of risks as well. Peter, any thoughts there?
I like how you said it guards against left tail and right tail risk. So when we talk about left tail risk, really what we're talking about is deflation or deflationary crashes, where things go a little bit sideways and haywire because prices are essentially crashing in a deflationary way. When we talk about right tail risk, it's different because we're actually talking about an inflationary crash. And both are crashes. They just have a different effect. One is a price crash, and the other one, a price crash to downside, and the other one's a price crash to the upside, where things basically get abhorrently expensive. And both are actually quite similar in terms of their end result, but gold actually protects against both.
Yeah, maybe let's bring up some charts. Let's kind of talk through this a little bit quickly before we get into some of the aspects around Hormuz. You got your charts up right there.
Yeah, I was ready to go, Adam.
So we're looking at gold compared to S&P 500 and
S&P 500
and total return index.
Yeah, a few little disclaimers to make here. Number one is the date, specific date on this chart, and that is March 15th, 1968. We didn't pick that date out of thin air, and the reason is on March 15th, 1968, that was the collapse of the London gold pool. And that's essentially the end of an era where governments and central banks were able to control the price of gold, or in this case, really set the price of gold. And that essentially stopped working at that point in time, and gold actually started to trade. So we're not showing the data before that because gold prices before March of 1968 were effectively contrived. They were just made up. And after that, they actually started to trade on an open market. So that's a really good data point to start. So that would be the gold line here. And the multicolored green and red line, that would be the Standard & Poor's 500 during the same time period. Just for this time frame, though, I'll get you to ignore the light green line because that's the Standard & Poor's 500 total return index, which is the S&P 500 plus dividends. But unfortunately, that index didn't start reporting until 1987. So if you're going back to 1968, it's just not going to work. The main takeaway from this is, when you crunch the math, so as long for the whole length of time, multi decades, that gold has been trading. So since March of 1968, the rate of return on gold is roughly 11,000% total return on gold since 11,000%. I'll repeat that. Whereas for the S&P 500, it is about 8,300%, which is still very good. It's just not 11,000%. Now, in fairness, once again, just so somebody in the comments doesn't, lambaste us for not including dividends. If you did include dividends, I would actually assume that the rates of return of gold and the S&P 500 are going to be pretty close during that entire time frame when you include dividends. But the main takeaway is over long periods of time, multi-decades, bull markets, bear markets, both gold and stocks go up. They just don't go up at the same time or in the same manner.
That speaks to correlation effect between the two assets and why they work so well in a portfolio together, that we want the long-term growth prospects of both, but we don't want everything that we own to behave the same way, such that we're riding a roller coaster up and down, and passion the clients do not want to take that ride on.
Yeah. Now, again, just in the interest of full disclosure, we're not trying to hide anything from anybody. I'm going to start at that March 1968 point, and I'm just going to quickly move forward in time just so we show how this chart changes. So right now, clearly, when you look at all data, gold has outperformed. But when you change the dates, these charts will also change. Depending on if it's a bull market for stocks or if it's a bull market for gold, and bear markets for both, and vice versa. So as you go forward, what you'll notice is when you start taking out the bull market in gold that occurred from 1971 to 1980, you get to a point where essentially stocks have greatly outperformed. And why is that? Well, we had a massive bear market in gold from 1980 up until the late 1990s, and we had a massive bull market in stocks during that same time period. So, of course, if you go to the early 80s, to present day, then all of a sudden stocks look like they did a lot better than gold. But again, you can't stop there. You got to keep going forward and forward and forward. And now we're in the early 90s, and now we're in the mid 90s, and now we're in the late 90s, and look at that. So if you go from the late 90s And I'll just even kind of move this forward right till 2000. So since the turn of the century, gold has, in fact, greatly outperformed the Standard & Poor's 500, both in terms of price return, because here we have gold at pushing about 1,400% growth since 2000. We have the Standard & Poor's 500 a little over 400%. And then if you include dividends and look at the total return index, you're at about 730% growth. But clearly, gold has outperformed this century to date by quite a wide margin, actually.
Pictures and timeframes are super important to understand.
Yes.
As it really gets deeper into the conversation of monetary policy and the regimes that have transcended this time frame, which I think our last podcast did a good job of kind of really hammering home. But once again, as a money manager and asset manager, as we're trying to achieve, you can see just from these charts how you can gain value from adding gold to your portfolio.
And I will also point out that there are times when gold and stocks actually go similar. Like, for example, from say 2015 all the way up till 2020, actually it was pretty fairly correlated. They're both going up in more or less a similar fashion. But then you look at it from say 2008 till say 2011, 2012, and clearly gold significantly outperformed. And then there were periods where gold would have underperformed the index during that same time period. And then, of course, most recently, since the Ukraine war, gold has significantly outperformed the stock market since Ukraine now. Adam, do you happen to recall why that may be?
Yeah, I mean, it was really the weaponization of the dollar, right? The U.S. 100%. Going after Russia in terms of sanctions. We've seen massive inflows to gold since this has happened, and this is a trend that is not going to be changing anytime soon.
No. Although, again, recently, if you look at the far tail end of this chart, you'll actually see gold dropping here since the beginning of the year. And we'll talk about that more because that is getting back to Hormuz now and how we'll tie all that in together. And you have stocks rising while gold's dropping. So to make a long story short, sometimes gold and stocks go in the same direction and sometimes they go in opposite directions, and that's okay. That gives gold what we refer to as basically no correlation long-term to the stock market. Sometimes it's positive, sometimes it's negative, but on average, it's actually zero.
Maybe hammer out the importance of the cross-currency relationship with gold and say US dollars, because that comes into play here.
Yeah. So essentially, on a very short-term basis, because gold trades in US dollars, it often is considered a cross-currency to the US dollar, meaning that because it's denominated in US dollars, all other things being equal in a vacuum, if the US dollar goes up, gold goes down. And if the US dollar goes down, gold goes up. But that's only true on a short-term basis because as time goes on, there's other factors that pull it in one direction or another. But longer term, gold actually puts a price on monetary inflation, which is the ever increasing supply of money in existence. Price inflation, which is often measured by CPI, and also monetary debasement, which is when countries do things that reduce the faith and trust in a certain currency. Let's quickly look at this chart here. This is related to the previous charts we were just looking at, but it's just shown in a different ways. Instead of pricing the Standard & Poor's 500 in dollars, which is what we have here, we have the Standard & Poor's 500, both total return index and nominal index going up in dollar terms. But interestingly enough, and this is since 2000, you see this nice rate of return in dollars for the Standard & Poor's 500. But if you take that same index and you price it not in dollars, but you price it in gold, so you price the return of the index in ounces as opposed to dollars. And I know that sounds esoteric to some people, but you can do that. You can price almost anything in any currency. It has essentially lost about 65% of its value. And I'm going to say that again. If you price the Standard & Poor's 500 in gold as opposed to dollars, in the last 26 and a half years, it's down 65%.
Peter, let me stop you there.
That might blow some people's minds.
But really spell out what that means to people. I mean, that saying the chart, saying what you said.
It means if you, instead of putting your money in the stock market, if you just held it in ounces of gold, you would have been even. But by taking value that otherwise could have been held in ounces of gold, which is what central banks were doing, you actually lost 65% in a total return basis. But again, just so nobody criticizes us, I'm going to show you the same number in the total return index. So if you include dividends, you've lost 42.82% as of today. Still down. Whereas if you look at it, monkey see, monkey do. If central banks are buying gold on net and accumulating gold, there's probably a good reason. These are smart people. They run countries' finances. They know something that many of us don't know. And if they're buying, maybe we should be too.
Let's see, we can see what the chart is telling, what the story is telling.
Yeah. And I know this, people may have to rewind this and watch this and listen to this a couple times before they understand it. But these numbers, we're not making these numbers up. They're right off the data sets here that we have. Now that's not always been true. Obviously, if you held stocks versus gold in the 1980s to the late 1990s, you would have done far better in the stock market than you would have done in the gold market. Conversely, if you held gold versus stocks in the 1970s, you would have done far, far, far better in the gold market versus the stock market. So they trade leadership. One group will have leadership over another for many years, and then it'll often flip.
So Peter, those charts tell a lot. Obviously, the play is to have more gold than not right now. That's how we feel. Maybe an interesting chart that, once again, would be valuable for people to see is gold held across central banks relative to FS reserves and seeing what are central banks reserving. Yes, there it is. That's the one.
There it is, yeah. Yeah, so again, people can remember a couple things. First of all, gold tends to trade on dollar liquidity. So meaning that when there's an excess surplus of dollars in the monetary system, whether it's dollars or euro dollars, but there's just a lot of dollars out there that need to go somewhere, they need to go into reserve, there's a surplus, gold tends to go up in price because for a simple reason that the central banks that have the surplus are going to buy gold with that surplus because they have the money. Now, if there's a dollar shortage, meaning that they don't have the money, then that's typically when gold sells off. And again, we do need to get to the Hormuz thing because that's exactly what's been going on of late. What this chart shows is based on all that, there are periods of times like in the 1960s and 70s where the primary reserve asset in the world was gold. And then at some point, when the value of gold basically gets too expensive and it just gets too high, central banks will start selling and they sell down their reserves of gold and they replace it with dollars. Again, when gold gets overvalued like it did in the late 70s and early 80s. And then you have a period of time like in the 90s and the 2000s and the 2010s where U.S. Treasuries still have a higher proportion of central bank reserve assets around the world. But notice what's been happening the last 10 years or even a little bit more is gold has been climbing during that period of time. And then just late last year, it actually overtook U.S. Treasuries as the primary foreign central bank reserve asset.
Yeah. And by all indications, we're pretty early innings here.
Pretty early innings. So now, did you want to kind of then now talk about how that relates to the war in Hormuz?
Yeah, and kind of the understanding of what a monetary asset is compared to a reserve asset. Maybe explain the two and how the liquidity needs to drive from one from the other.
Yeah. So just think of it like your savings account versus your checking account. So monetary asset is essentially your checking account. It's cash on hand that you have to go buy something. It could be in a central bank's case, it could be energy, it could be food, it could be missiles, like in a war, it could be anything you need, but it's actual currency that you can use to buy something. But your savings account is something a little bit different. That's where you're saving money. And then even more than that, maybe your investment account. So think of gold more as a reserve asset, which is not a checking account, it's an investment account. So i.e. you're investing your capital such that it's worth more in the future, not out of greed, but out of necessity. Because what you want is to be able to buy more stuff in the future, and you can today if you invest properly. So in the lead up to the war, and remember, like there was war drums being beaten for months, prior. You have obviously had your Ukraine war. You have what happened where U.S. Treasuries that were owned by the Russians were confiscated, and then you had a build. You had Donald Trump winning the election, and you had, an indication that there may be a war in the Middle East. So think about it this way. It's like, if you know there's bad weather coming, so if you're a central bank and you know there's bad weather coming, there's a problem coming, there's a war coming, what are you going to do? You're going to save. You're going to basically stockpile resources. You're going to stockpile oil. You're going to stockpile food, perhaps. Maybe you stockpile missiles. But guess what? You also stockpile gold. Why? So you have something to sell on a rainy day for cash.
That's right.
And so the buildup and the run-up in price of gold occurred before the war, not during or after. It was an event in the lead up to the war. Once the war actually occurred, that actually now flipped, from a position of surplus savings to a necessity to basically use that surplus to buy stuff. So maybe we can talk about how that occurred.
Well laid out. These reserve assets are there for a reason. Oil prices over $100. Central banks and everybody, they need to buy oil. Well, this is the rainy day fund.
This is the rainy day fund. And then so what happened during the war? Well, you had an attack on Iran, which is reciprocated by, an attack on the Gulf states. So Gulf states, essentially missiles coming from Iran into those countries, which then required them to use their missiles to try to shoot down the Iranian missiles, which costs a lot of money. And once you blow up a missile, you need to buy a new missile. And to buy a new missile, you need cash. You need US dollars, typically. So at the same time, they were expending missiles in defense and other munitions. And they also took damage on top of all that needed to be repaired, which is all basically a demand and a need for dollars. The Strait of Hormuz was closed. And if the Strait of Hormuz is closed, that means those same Gulf states, which need dollars to buy stuff like missiles, say, for example, they can't get their oil to market because they can't get their oil out of the Strait of Hormuz. And if they can't get their oil out of the Strait of Hormuz, then they can't get dollars for their oil that they can use to go buy stuff. So if they're not getting the oil market, then they can't get dollars, for that oil because they can't sell their oil. And if they can't sell their oil, now we have what's called a dollar shortage. That means basically you need dollars to go buy stuff and you don't have the dollars. And so those dollars that the Gulf states now could not get, they either had to borrow, say from the United States government, which is called a swap line, which is essentially a line of credit at the Federal Reserve. And that's what happened to the UAE, so Dubai. So UAE, Dubai essentially had to go to the Federal Reserve and get a swap line, which is like a line of credit so they can get dollars because they couldn't get their oil to market. And right at the same time, they need to buy missiles and they need to replenish their stockpiles.
And that swap line was something that's not easy to attain and not readily given out either, right? So
correct. Typically only to G7 nations.
Yeah, the dynamics at play geopolitically here across the world is rapidly changing, and this was a great example. And obviously, a major impact and result of this was UAE leaving OPEC.
That's right.
So
I'll pause you there. That was a big deal.
Yeah, it is a big deal.
Yep, very big deal.
For us, it definitely changes the dynamic of where we're going here. Mm-hmm. In terms of, we talked about investment playbook. Peter, where does that take your mind into where we think we're going?
And again, this could be a whole podcast in and of itself, but if I'm going to grossly oversimplify and summarize, you had the U.S. attacking Venezuela and rerouting their oil shipments that were destined for China, rerouting them to the United States, to Texas, essentially, which gives the U.S. surplus oil over and above what it already had, and surplus heavy oil, too. And at the same time, then, right after that, they invade Iran, which causes, obviously, a response from Iran, which closes the Strait of Hormuz, which creates an oil shortage. But wait a minute, they had, obviously, surplus Venezuelan oil to kind of fill the gap, at least to some degree. And then let's not forget that 2 years ago, OPEC and Saudi Arabia did not renew the petrodollar arrangement with the United States. So, and that arrangement's been around since the mid-1970s, I think 1974, if I'm not mistaken. And they did not renew it 2 years ago. So, and then now this happens, and then UAE leaves OPEC in exchange for a swap line, which is a line of credit, which is necessary based on the war in Iran, which then destabilizes OPEC, as it does. They're a major contributor to OPEC, and then leaving OPEC destabilizes OPEC, which reduces their significance to some degree and definitely increases the significance or the dominance, in this case, of the United States and global oil markets.
Yeah, and I think to kind of tail onto that, if we're looking at next 10, 15, 20 years, I think the name of the game is lowest cost energy producer wins.
That's right.
And we're looking at an era of AI, an
Mhm.
era of how important power is to be able to run these data centers and the hyperscalers, everything that they need. Power is a major part of the conversation here. So,
Mhm.
in terms of how we think about investing money over the next long term, 5, 10, 15, 20 years, this is going to be a very important theme that we need to be aware of.
Yeah, and I'll touch on one thing you said there. You said lowest cost energy producer. So cost meaning not just dollars, but cost also in terms of risk, i.e., if you're reliant upon, say, oil from the Strait of Hormuz, and you're just one war or disaster away from you not getting that oil. So it's not just about straight up dollars. It's also about what do you want to call it, risk
Yeah.
or pain in the you know what factor.
Yeah, no, I mean, I think that's really perfectly said because one could ask, why is Strait of Hormuz closed? Does Iran want
Mhm.
it closed? Does the U.S. want it closed? As we can get the grand chessboard here, we're trying to get to what is really at hand.
Yeah, and I'll just maybe finish off by saying this is a tremendous opportunity for Canada because there is a demand globally, not just for oil, but for a safe, stable supply of oil that can be trusted. And this war just proved how disruptive it can be if you're reliant upon oil sources that are ultimately not reliable.
Yeah. So quickly, Peter, what are some of the targets for gold you think here in the next bid? Maybe 2026 or maybe by the end of the decade?
Yeah, so it's interesting. You start seeing some of these estimates that are coming out of J.P. Morgan and Goldman Sachs in the U.S., which normally would be very conservative on gold. They're up in the high 5,000 range and the low 6,000 range from what I've seen.
For this coming
So
year.
yeah, which
Yeah.
ironically, even though we like gold, I would say is probably at the high end of what we would have classified as a target, but yet those numbers are being floated around out there. Gold is trading right now just below its 200-day moving average, and assuming it can stabilize here short term. And again, just to kind of wrap up what we were saying earlier, why it went down, the price went up last year as it was being accumulated pre-war, and it's come down this year because those same reserve assets that were being accumulated were now needing to be sold by countries who needed dollars. Yeah, short-term targets would be generally higher. Again, could be high 5,000s, could be low 6,000s. Longer term, it's, sky's the limit really. Like if you just had a little bit of fun with some math, if there was a need or a want to try to level out the trade deficit with China, like the U.S. trade deficit with China, you would need gold up in that low 20,000 range, which I know sounds crazy, when you kind of throw that number out. But if that was a thing that we wanted to make it such that the trade deficit would disappear, that's roughly where gold would need to go for that trade deficit to flatten out to somewhere near zero. Now, even further on, if you at all want to compare this to the 1970s, which I'm not exactly saying that we should do, but if you just want to have fun with it, the bull market in gold in the 1970s, which ended in 1980, did not end until the total market capitalization of gold held by the U.S. Treasury exceeded by a fair margin actually, the total amount of U.S. debt held by foreigners. So think of it this way, or put another way, if you have all this U.S. debt out there that's being held by foreigners, those foreigners liked the idea or maybe perhaps wanted the U.S. debt that they were holding in the form of treasury bills to be pseudo-backed, covered, collateralized, let's just say, by gold. And because the U.S. wasn't accumulating more ounces of gold necessarily, what we needed in the 70s was a higher price of gold such that the total amount of gold on deposit market value wise exceeded the amount of U.S. debt that was held by foreigners. If you were to apply the same metric today, which I'm not saying we should do, but if you want to have fun with it, you would need to equalize that. So if you, to get roughly the same amount of foreign held U.S. debt to equal the amount of gold on deposit in the U.S., you need a price of gold in the mid 30,000 range to get there. And if you wanted to exceed it to the same level as it was in 1980, it would have to be actually in excess of 40,000 an ounce. Not saying at all that that's what's going to happen, but it is interesting to think that if you want to compare it from a valuation standpoint as it pertains to U.S. government debt held by foreigners, those are the kind of numbers that we're looking at ultimately, which could take years, by the way, to play out. I'm not saying this is going to happen this year.
Yeah, no, these
Yeah.
usually are multi-year
Yeah.
cycles, as you talked about, decade-long events that play out. But back to the earlier comment, early innings is kind of where we are. And if you
Yeah.
think gold is tapped out here, just kind of put some of those numbers and thoughts in perspective to understand where we're going. And you backtrap that on the fiscal situation globally.
Yeah, and then again, just in summary, you already touched on this earlier in the podcast, but why do we as asset managers own gold? Number one, to improve total returns in portfolios, and like we were looking at the charts earlier, clearly it works. At least it's worked since the beginning of the century. Like adding gold to your portfolio has improved your total return. The other one is to decrease volatility in the portfolio, because if you have equities and if you have gold in a portfolio, both are going up, but they're not going up at the same time or at the same rate. You essentially have their correlation to each other is essentially near zero over time. It's not always zero, but it's zero over long periods of time. And so when you do that, your risk and your volatility in your portfolio go down. And that can be measured with something called standard deviation, but essentially your standard deviation goes down significantly, which then increases our Sharpe ratios, which is risk adjusted returns. So it gives us as money managers very, very high, call it industry leading Sharpe ratios for our clients. And then you said it earlier, but it guards against both left tail and right tail risk in portfolios, meaning it guards against both deflation and inflation, which is pretty special.
Yeah, and I think if you look at the history of civilizations, global hegemons, at some point there's always been a currency crisis or some sort of currency devaluation.
At some point.
At some point.
Yeah. Yeah. And again, we're not quote unquote doomers, so to speak. We're not necessarily negative on things. In fact, we're actually positive on quite a number of things going forward here. But we own gold first and foremost for insurance and our portfolios. It's not necessarily for any sort of speculative reasons. It really is portfolio insurance.
Yeah, no, well said. Well, I think we touched on a lot today, Peter. Got a gold update for everybody. I think the liquidity issues with gold, and as we talk energy needs, central banks, sovereign nations needs for to tap the piggy bank, if you will, to be able to fund the necessary needs. I think we explained that really well. We got some targets and thoughts leading forward, and I think letting everyone know that gold still is a very valuable tool.
Yeah, and again, even though we've had a very significant correction in the price of gold this year, it's still up significantly compared to where it was last year.
Right now, accumulating and buying more, this is a good entry point for clients.
It is. I would agree.
Very good. Well, thank you
It's
for
great, Adam.
everyone. Appreciate it. And like and subscribe as always. And please share this with anybody you think might like to hear it. And we'd love to connect and discuss more.